Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform 2.0 to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services Leader. You can watch these podcasts on YouTube at youtube.com/Doug McHoney. On this week's episode of Cross-Border Tax Talks, we're in Westminster Studios in St. Louis, Missouri, where I'm excited to have a fully vaccinated Sherry Grabow on the podcast. Sherry leads PwC's international tax practice along with me and is based in PwC's Chicago office. Sherry and I both started our careers in St. Louis over 20 years ago, and prior to being admitted to the partnership at PwC, Sherry has had 2 stints in industry as a senior tax attorney and senior tax manager. Sherry, welcome to the podcast.
Thanks, Doug. I'm excited to be here. Excited to be back in St. Louis.
Well, we've been talking about this for a while. It's great to be fully vaccinated, hopefully getting back to normal as we're getting back into the office. So before we dive into our topic at hand here with respect to the chairman's mark from the House Ways and Means Committee, and oh boy, do we have a lot to discuss. I wanted to maybe break the ice with you grew up in Iowa, but went to law school just down the street at Washington University. And you spent almost 20 years in St. Louis before relocating to Chicago. Mm-hmm. So maybe before we get started, tell me, what do you miss most about St. Louis now that you've been in Chicago for, I think, over 10 years now?
That's right. That's right. And I lived in St. Louis longer than anywhere in my life because I was part of an Air Force family that moved around a lot too. So I claim Iowa as home, but I really lived in St. Louis for a very long time. And, so I miss family and friends, of course. But in terms of the city, I love St. Louis, always have. I think it is a city that, for its size, just has a lot of character. There's so many different neighborhoods and interesting places to go for entertainment, eating, dining, like, here in the Loop where you live, mm-hmm. or, the Hill, just a lot of character. And just, I think it offers a lot for a city this size. So, which is not small, but it's not huge like Chicago, but I think there's a lot of great things here.
Yeah, I didn't really appreciate kind of the size and magnitude until when we lived in Chicago for 5 years, right. And what a massive city that is compared to St. Louis. And I think from Chicago perspective, we really enjoyed our 5 years there. And the thing that I enjoyed about Chicago the most undoubtedly was the lake. We loved mm-hmm. heading down to the lake. We were less than a mile from there. And we don't have one of those here in St. Louis. We got a big river. We got 2 of them, right. In fact. So, all right. Well, let's jump into the topic at hand here because there's plenty to discuss. So on Monday, September 13th, the House Ways and Means Committee revealed its much-awaited chairman's mark for the tax increase portion of the budget reconciliation language, and the JCT released its description of the chairman's amendment. The proposal included a number of corporate tax, individual, and compliance provisions in an effort to raise a whopping $2.9 trillion over 10 years. Now, since this is the Cross-Border Tax Talks podcast, we'll be focusing today's discussion on the international provisions of the proposed legislation, which are expected to raise $900 billion in and of themselves. Now, the really big highlights, I think, are raising the corporate tax rate to 26.5% and retaining the current expensing for research and development through 2025. I know that was on the mind of a lot of advisors and taxpayers. One caveat that I'll make, Sherry, is that neither of us are from inside the Beltway, so we'll leave the political prognosticating for our Washington experts, and trust me, they will be back on the Cross-Border Tax Talks, and instead we'll be focusing on the technical provisions as proposed. So you ready to jump right in, Sherry?
I am.
All right, well, let's start with, and I think we'll just take the order that we saw in the JCT report as we're going through some of the highlights, and talk about interest, because this is a provision that I think will impact a significant amount of both our foreign and U.S.-based multinationals. So why don't you provide some of the highlights or lowlights on interest?
Sure. Well, like you said, this one's a big deal for our clients. It'll impact a lot of our clients who are U.S.-based multinationals. And what it does is it doesn't do away with 163J. That's still there. It adds another limitation, a new provision, 163N. And the new 163N essentially operates to limit interest of a U.S. group that's part of what they call an international financial reporting group. And the interest is limited based on the U.S. company's relative portion of essentially EBITDA, their earnings in the group. And so, for companies that might have a lot of borrowing in the U.S. but are part of a multinational group, now that limitation is going to be prorated based on relative earnings. So it could potentially be a very big limiter for U.S. companies that operate internationally.
That's right. And I think that, many U.S. multinationals particularly, and again, this impacts both inbounds and outbounds, but particularly many U.S. multinationals take out all of their external debt in the U.S. or a significant portion of their external debt in the U.S. And for those companies that do that, you're right. The way I think about kind of the simplified formula, it's about 110% of your net interest expense. So you net the income and the deductions, and then multiply that, as you described, as your U.S. EBITDA over your worldwide EBITDA. And there will be a number of companies that get limited. There is a floor. It only applies to the extent that you've got $12 million of net interest expense, but obviously for many multinationals, that floor is not going to be very impactful. I do think it's interesting that part of the rules have the 5-year carry forward now. So for both 163N and 163J, whatever expense is non-deductible gets carry forward for 5 years. Under the prior rules, that 163J amount was unlimited. And so I think there were relatively few, particularly public companies, that were reserving or putting up a VA against that carry forward because it was indefinite, although there are certainly some instances of that. But I think that the financial statement implications will be very important for companies, given that there's only a 5-year carry forward. One other point to note is that any prior carry forward prior to enactment, I believe, is not subject to the 5-year carry forward rule, right? It's only for the 163J amount or the 163 amounts after the date of enactment.
Right. And that's a good point. And I think we'll talk about that as we go through, right? But most of these provisions are prospective. There are a few exceptions to that. But in terms of this particular provision, as you said, it's prospective. In addition to just the limitation concerns that you mentioned, I also just think this will be another area where it's more work, more calculations for companies, as they have to now do another calculation to come up with this additional limitation and look at it. It's not, like, as we said, it's based on financial statement earnings and reported income and interest. So it adds another sort of layer of complexity to those calculations. Yeah,
it's a great point that U.S. EBITDA over worldwide EBITDA is not something that you would generally find. It's not something that you would find on an existing 1120. And so, I think one of the things that will be a theme as we go through this, and frankly, this has been a theme of U.S. Tax Reform 1.0 and the TCJA, is just the sheer amount of complexity that taxpayers have to try to comply with these rules. And this is just going to be something else to track, both from a tax perspective as well as from a financial statement perspective, because companies are obviously going to need to understand, if they're able to utilize these carry forwards now that there's a 5-year window for it.
Agreed.
So the next one I wanted to move to was foreign derived intangible income. So a number of changes here. Do you want to provide some of the highlights?
Right. Well, the big headline change is around the rates, or the deduction percentage. So the prospective, again, adjustment will reduce the deduction from 37.5% to 21.875%. So that gets you to an effective rate now on FDII income of 20.7%. So that's obviously the big change. But there are a few other things in the provision. And one thing that I think is key is that it's not taxable income limited. So that's also a change that would be favorable. It can put a company into a loss position, unlike in the past where there was a limitation on the 250 deduction in general.
Yeah, I always thought that was strange, right? So companies with an NOL that would recognize GILTI because of the taxable income limitation as originally put in the TCJA, they just would lose that section 250 deduction. Yeah. So I think that's a welcome change for many taxpayers. They still get their deduction, and it can just simply increase the NOL.
Yeah, and I think another thing that's sparked a lot of discussion in the last few days since this came out is there is a provision that modifies the definition of deduction eligible income to exclude some additional items. And one thing in particular that's concerning is that there appears to be an exclusion for income that would be of a type that's similar to foreign personal holding company income. And that appears to be a technical correction. It has retroactive application back to 2017. And so, we're still kind of waiting to see what happens with that, if it stays or not. And it seems to be just kind of not necessarily consistent with what one would expect or think, given the purposes of FDII. So more to come on that. But, it sparked a lot of concern that could potentially apply to pull things out of FDII, like royalties or gains that, we would otherwise expect to have in those provisions. And coupled with the fact that it's potentially retroactive is a big concern.
Yeah, let's spend a few minutes with that because you're right, Sherry. This is really could be very, very impactful. Right. And so I think what they borrowed from the definition of foreign personal holding company income, and there are a whole bunch of other additional rules in the 904 regs that provide for look-through treatment for foreign tax credit purposes. But under a strict definition of the foreign personal holding company income, a royalty received from a U.S. parented group from its CFCs would fit within this
right.
definition of foreign personal holding company. So what this means then is that, and your other point is that this goes back to 2017. And so what this means is that if you're a taxpayer that brought back IP back to the U.S., maybe you had your IP offshore and you brought that IP back to the U.S. because you had thought that you could qualify for FDII, which was one of the big policy reasons justifying FDII and also the marrying with the rate with GILTI. If you brought that IP back to the U.S., or if you were a taxpayer who never brought that IP offshore in the first place, the FDII deduction that those taxpayers have taken since 2017 would have to be reversed. That cannot be the answer
right.
that was intended
right.
from Congress. And so one can hope that gets fixed and changed or clarified to make sure that related party royalties do qualify for that FDII benefit, because that one is a significant concern to a number of taxpayers.
Right. And there was talk leading up to the release of the chairman's mark that would there be anti-abuse provisions or anything of that nature? And there's not specifically, but this provision is obviously concerning, and there isn't any discussion of it in the Joint Committee explanation either. So,
all right. So you had mentioned the new FDII rate at 20.7. Let's move to GILTI now. One of the things that I think is very interesting is that the FDII rate, which is 20.7, has now been decoupled, if you will, from the GILTI rate, which is now at 16.525. These are all very interesting percentages that I assume may change as we progress down the political process, both the corporate rate and the FDII and the GILTI rates, to get the numbers to work. But it's currently set at 16.525. That is just one of a number of changes to the GILTI provisions. What else is being changed?
So I think the big headline there is that we are seeing a country by country approach. Mm-hmm. So that was talked about and somewhat anticipated, of course, but the provisions do explain that the GILTI calculation will no longer be this aggregate computation, and it will be done on a country-by-country approach. I think when you look at the language in the text, but also even in the Joint Committee explanation, it's not entirely clear that calculation is not by entity, because it uses language that they use a taxable unit as the new measure for determining the GILTI calculation. So every item of income or loss is associated with what they define as a taxable unit, which would be a CFC, a branch, or a flow-through, each of which would be a tax resident or a tax-paying entity. And so when you look at that language, one could read that to say it might be on an entity basis, and it doesn't explicitly say that it's aggregated by country. So, I think the intent, if you kind of read some of the broader language in the JCT, it does refer to a country by country calc, but it's just a little bit unclear in that language. But either way, big change in terms of how you would do the calculation. Again, another area where there's a lot more work there for companies to think about doing that when you take that in conjunction with not just the GILTI calculation, but the foreign tax credits that are associated with the GILTI done that way as well.
Yeah, and they seem to be borrowing from the tested unit concept that we saw in the high tax exception regulations, but have specifically called things a taxable unit now and have some new definitions that we won't get into some of those details. But you're right. The way I'm reading this is that, companies it is going to be a significant compliance burden to be able to track your GILTI on a country by country basis. And we'll get into this. And then the commensurate foreign tax credits as well.
Right.
If you're a medium to large side multinational, you're going to have a lot of different baskets to be able to track depending on what country you're in, and then also depending if you've got branch or sub F income, which we'll get into. A couple of the other points that I wanted to point out was that QI survived. I think, at least again, this is all
Another
just that
little bit of a surprise.
Yeah,
right?
a little bit of a surprise. And again, this is all just in the House Ways and Means draft. Still a lot of runway before any of this is finalized, but they've reduced the QI return from 10% to 5%, but that survived. And then another thing that I found pretty interesting was the carry forward of tested losses to the following year, to the succeeding year. So to the extent, and this would seem to account for some of the from timing differences, and particularly for companies that operate in very cyclical type of environment, that it does allow you to carry your tested losses to the one succeeding year. Now, I'm guessing not everybody's business cycle is necessarily a year long, but it still does appear to be a welcome change. One of the other things on GILTI, and really relevant for oil and gas, and this is a really big change for the oil and gas industry, is the inclusion of foreign oil and gas extraction income. And so that income had historically been excluded from GILTI, and so for those companies that are operating in that industry, it's a really big change.
Agreed. And I think, as I mentioned, the FTC component of it, so there are several changes in foreign tax credits, but specifically as it relates to GILTI, some of those changes are significant. So it's, computing the GILTI associated foreign tax credits on a country by country basis again, which is a change. And there's some other favorable rule changes in relation to GILTI. So, we're all accustomed to the 80% haircut for taxes attributable to tested income. That is being increased to 95%, so more ability to use credits, which is a good change. And one of the big headlines, I think, in these changes is around expense apportionment. So they explicitly say that only directly allocable expenses will be allocated to GILTI income, and that specifically means the 250 deduction. So all the other expenses that have been the source of a lot of leakage for our clients, in the GILTI basket, R&D, stewardship, interest, those are not going to be apportioned to GILTI income. So overall favorable changes, as well as taxes associated with tested losses, I think can also be included. So several changes to the foreign tax credit regime as it relates to GILTI. And another one, not the least of which, is the ability to carry forward excess credits in that basket, which hasn't been the case. Is not the case under the current rules. So, that group of changes is obviously taxpayer favorable as a whole, and also, just as you and I have talked about, simplifies the calculation of credits and kind of simplifies, I think, the overall regime.
Yeah, a couple of reactions to that is first of all, it really appears that GILTI now looks a lot closer to an actual top-up tax, right? Without the expense apportionment and allocation. And I mean, it really looks like that the House Ways and Means staff spent a lot of time with that OECD Pillar 2 proposal and understanding the mechanics of that and really trying to make this a Pillar 2 compliant regime. So
Agreed.
I think some of those changes are very welcome. You had mentioned the foreign tax credits and with respect to GILTI. Now, while we no longer have, and it does mention specifically that only the 250 deduction, understandably, gets directly allocated to your GILTI and not the stewardship, interest expense, and R&E like we had in the prior, or under the existing, I should say, regime. But I will note that the separate loss limitation rules still apply, particularly to GILTI. And so want our listeners to understand that while there's no actual expense allocation, to the extent that you do, whatever interest is left to be deducted after 163N and 163J, that and stewardship and R&E will get allocated to the general basket, which we'll talk here in a few minutes. But if you end up with a loss in your general basket, that can then slop over, is how we like to use the term. It can slop over to the GILTI basket. So I think that taxpayers, and we'll talk about this at the end, modeling, as taxpayers are thinking about modeling this, they need to be careful with that kind of whipsaw, if you will, to the extent that the interest expense gets allocated and you end up with a loss in those other baskets, then the loss comes comes back into GILTI. The other thing that I wanted to mention is you had mentioned GILTI with respect to separate country baskets, and we can talk about kind of the changes to the general basket. But I'm just thinking about the compliance aspects of trying to manage a separate GILTI basket, and you had also mentioned the 5-year foreign tax credit carry forward. I'm particularly thinking about our public companies, but this is obviously relevant to anybody paying cash tax, is that so we're now going to have to track our foreign tax credit carry forward in every single GILTI basket, thinking about a 5-year carry forward. And so you're going to have to do the analysis from a book perspective. Do you need to put up a VA? What's the likelihood of being able to use those taxes in the 3-year period? And then I'm just thinking of trying to actually track all of these things in the schedule. We kind of got spoiled. I remember early in our career, Sherry, when I had a big 1118 with a ton of 1050 baskets. And I feel like this is we're dating ourselves.
Yes.
I feel like this is the 1050 basket on steroids now, and just how complicated the 1118 was back then. And it's only got more complicated. And just to be able to have to track all of that is certainly going to be a burden for taxpayers, financial statement auditors, and everybody trying to keep track of all that stuff. Yeah, so let's move to foreign tax credit outside of GILTI. And so there were some big changes with respect to how foreign tax credits are calculated, particularly for the historic branch baskets, and then for any we would have called the general basket, so subpart F, or what they now refer to the residual foreign tax credit, residual general foreign tax credit basket. So help us try to unwind some of those rules.
Right. So I think the big kind of headline changes are, you mentioned the carried forward. So there will no longer be a carry back. There will be a carry forward that no longer is 10 years, it's 5. So that's for all foreign tax credits, like we said, and including GILTI. So, that could be a big consideration for our public taxpayers, as you mentioned, in terms of reporting. In terms of baskets, as you mentioned, the branch basket is going away. And so that will lead into some considerations about just characterization or basketing of certain types of income and where that goes. The SLL point, I think that you mentioned, is a key one. And I don't know if we touched upon it, but the SLL calculations for GILTI actually get aggregated. So there is that provision in GILTI, which is favorable. But yeah, overall, I think just the big shift is that, again, we're making another change in the number of baskets we have, which, has the knock-on effect of changing our computations and thinking about now kind of what, with that branch basket gone, which a lot of our taxpayers or our clients rather did have excess credits in that basket. It's now thinking through, where does the income and associated credits align in terms of, the per country baskets, or otherwise in terms of just being part of what they call like the general basket that would be associated with the U.S. taxpayer. Yeah.
So the way I'm thinking about this, and I think, we're all still, and I probably should have caveated early in the podcast, we're all still thinking through and understanding some of these provisions and trying to understand the JCT report as well as the legislative language. But the way what I'm taking away from this is that, so as you mentioned, we'll have a separate GILTI, we'll have a basket for each country that we operate in from a GILTI perspective. So assuming you've got positive income or net tested income, you're going to have a separate basket, if you will, within GILTI for every country. And then they've also appeared to put a similar architecture for the general basket. So to the extent that you have taxable units in the U.S. that maybe would have historically been a branch basket,
Right.
that those credits would then get amalgamated, if you will, with any foreign tax credits in the same country that maybe were sub-F income.
Yep.
And so now all of those just go into one general basket. And you had mentioned you get the 5-year carry forward and no longer the back one forward 10. Again, those are only prospective. So any credits that come up this year and prior years, you still get your 1 and your 10. But then there was also there was a footnote in the JCT report, and I think the comment was the residual foreign tax credit basket, which led me to interpret that to the extent that a U.S. multinational is still receiving, let's say, royalties or interest or what would otherwise be general basket income following the existing 904 regulations, that would appear to go into a residual general basket. Mm-hmm. And so we'll have, these various components of the general basket. And again, from a compliance perspective, it's going to be very challenging. I think one of the many, many unanswered questions is, well, what happens to foreign tax credit carry forwards that are now just in the general basket? And it'll be really interesting to see what they do with those transition rules.
Mm-hmm. Agreed.
So a couple other things from a foreign tax credit perspective is applying the 338H16 methodology to GILTI now. And so any dispositions involving a hybrid entity, so if you've got a checked entity held by a CFC and that is sold to a third party, that today is GILTI income. And even though it's not taxable in the foreign jurisdiction, but what they've said is what they said is presumably because that generally that type of situation may not be taxable in the local jurisdiction. Obviously, it depends on what jurisdiction is holding that disregarded entity. That they would say that income is no longer GILTI. And so that would go into, I guess, the passive basket, and you wouldn't be able to use that to soak up any excess foreign tax credits. There's also some provisions on specific economic benefits, which, if you're a taxpayer or an advisor that applies to that rule, they're really codifying, I think, what has been in the regulations.
Yeah, I think the other provision that I think of it as tying into foreign tax credits is just the provision that would make it such that CFCs could no longer have a different tax year end than their parent. So for a lot of our clients that might have, for instance, if you're a calendar year taxpayer, an 11/30 year end, this provision would strike that and give taxpayers that would no longer have the ability to have that different CFC year end. And, that could certainly, particularly depending on how that is transitioned, could have some big, foreign tax credit implications to our clients.
Yeah, that's a great point. That's probably worth spending a minute on in that, if companies, if you're a 1231 taxpayer and you had 1130, and reminder to those reg writers and the statute writers that, holy cow, because of the uncertainty with CFC look-through, again, I'm dating myself, that there were a number of taxpayers that adopted the 1130 year end to be able to qualify for look-through, as every year we were all anxiously waiting to see, is look-through going to get extended? Is it not going to get extended? Is it going to get extended? Is it not going to get extended? And then it would always get extended, but we would do the 1130 year end change as one way to potentially increase, or to toll the amount of time that you would get for look-through. And the concern that we have for taxpayers that have 1130 year end, when that change occurs, that means that those taxpayers are going to have a stub period from 12/1/2021 to 12/31/2021 for a month. All of the foreign tax credits for that year would end up in that one month period.
Right.
And your concern, I think, is that, and I'm not sure how much there is to do given the timing, but that what could result is that you end up with this 1 year period. And if your total amount of the taxes paid exceeds the amount of income that you have in that 1 month, you're going to end up with the tested loss, and you're going to lose all of your foreign tax credits for the year in that particular jurisdiction. That seemed to me like a pretty harsh result without any transition opportunity. And I do wonder if the statute writers contemplated that and realized that what they put at risk for the foreign tax credit. So let's move on to subpart F, because this is an issue that you know is near and dear to my heart. I've spent a lot of my time on the branch rules in particular and subpart F. So tell us a little bit about subpart F, because there I would call sweeping changes to the subpart F rules that have been around since 1962.
Right. And I would put that, at least in my mind, on the surprise list. It was surprising to me. And yeah, what you're getting at, Doug, is there's a provision that relates to foreign-based company sales income and services income. And specifically, this provision states that those rules wouldn't apply to a CFC unless it was a U.S. taxpayer. So essentially, to your point, it kind of takes the teeth, if you will, out of those provisions. And that would affect a lot of our clients and taxpayers in terms of just those that have offshore activity and intercompany transactions that could otherwise fall into those rules, which is many companies, right? Because a lot of companies have principal structures and, supply chain structures where those rules come into play. So limiting the application of those rules to only, U.S. taxpayers, would essentially just be a sweeping change to those rules. And, it's interesting. I think it will, it would offer some flexibility, certainly, as companies are thinking about their supply chains and how those rules could apply. But you're right, like it's a major change to a regime that's been intact for some time now.
Yeah, and it was interesting to me how they actually did it, like what the mechanics were within the 954 architecture. So as you stated, now CFC to CFC transactions, unless a CFC has a U.S. trade or business or U.S. taxable present, I think is the terminology that they use, that subpart F is now turned off between CFCs, and the related party that you need has to be a U.S. person. So again, it's only going to be transactions now between the CFC and the U.S. person. But they changed that related party definition by inserting it in 954 and replacing 954 D2. And I remember when I went through that, I was like, that I figured it was a typo. I'm like, wait a minute.
Yeah, I had to reread it a couple times.
I was like, wait a minute. They put in a modifier for the related party rule, which is actually in D3, and they added that to D2. And I was like, well, no, D2 is the branch rule. But I think that we're all in agreement that, they replaced the branch rule. And this goes back to my earlier comment about kind of OECD BEPS Pillar 2, that, they've really taken some of the other complexity or issues out of GILTI. Now, everything's just GILTI. It's like, listen, if you're operating foreign to foreign, everything's GILTI. The subpart F rules are totally turned off now.
Right.
Again, absent the exception if you've got a U.S. taxable presence in the CFC. And so those rules are now turned off, and the branch rule appears to be replaced. All right, so last but certainly not least, and we will talk about a myriad of other relevant provisions, but is the beat. So this, they call it the beat still, but it doesn't really feel much like the beat that we've come to know over the last few years. Tell us about that.
Yeah, some big changes there, and I'd say some of it's good news and some of it's bad news for taxpayers depending on their profile. I think the big change is, one of the big changes is in the rate. So, it's currently at 10%. It will stay that way for a couple years, and then go up to 12.5%. And then in 2026 and beyond, that rate goes up to 15%. So that's a pretty significant change. Mm-hmm. In terms of the scope, they did clarify that payments for inventory are included.
Big change.
Okay, so that's a big change. But there is some relief in it, in that they specify that income that is subject to U.S. tax, so inclusive of GILTI, withholding tax, et cetera, would not be considered a base erosion payment. And then they also have a shield-esque provision that basically says if it's subject to sufficient foreign tax, that it would not be considered a base erosion payment. And so, that, depending on how that's defined and interpreted, would look to be potentially helpful in alleviating some of that. Also, the exception for SCM still applies. So, there are some carve-outs in terms of limiting the amount, but, that is a big change, if you will, that they're explicitly confirming that inventory payments are included.
Right.
Yeah.
And I think, the highlights, particularly for the U.S. MNCs, is that this architecture would turn off BEAT for U.S. MNCs, because the fact is that payments are made outbound to a CFC. They're subject to GILTI. So that would just simply turn off the BEAT to the extent that it's subject to tax and GILTI or sub F, which is, I'm sure, a welcome change for U.S. MNCs. And then the second observation I would make is that this really starts to look like the undertaxed payment rule in the BEPS Pillar 2. Somebody did their homework on the BEPS Pillar 2, and you made the point that as long as it's subject to tax at least, and I think it's the BEAT rate, then it's not going to be considered an undertaxed payment. It won't be a beatable payment. And so it does appear that the scope of the BEAT has been significantly limited in certain respects, but then obviously cost of goods sold is a much bigger change.
Right. And there were some other helpful changes in there in terms of the credits. So credits can be used to offset the BEAT liability, and their foreign tax credits, for instance, are no longer excluded. So it does away with that GILTI boomerang. And then I think another provision to point out too is just the limitation of that 3% threshold for being in the provision. So your base erosion percentage being 3% or more, like that is being taken away after 2024. So just something that might take some taxpayers by surprise as well.
Yeah, that one people will obviously need to keep an eye on. And it'll be interesting to see, frankly, what, if any, changes as the legislative process goes forward, what may happen to the BEAT.
Agreed.
So maybe we just kind of do a hodgepodge here of some other relevant provisions, because this is really just the tip of the iceberg, and we only have so much time here on the Cross Border Tax Talks podcast. But were there any other provisions that you thought were worth highlighting that could be significant changes for taxpayers?
Yeah, I did. What did stand out to me, there were a couple of provisions kind of going back into that sort of subpart F and foreign tax credit space. I believe they confirmed that when there's a withholding tax on a distribution out of PTI, that there would not be an increase to the Section 78 gross up. That stood out. I think also they confirmed that, CFC to CFC distributions under 961 could lead to taxation, which, was an area that I think prior to this provision coming out, it was subject to, interpretation, right?
Yeah, I was a little shocked by that one, frankly. And for taxpayers, just to be really mindful that you don't get that basis bump in lower tiers.
Exactly.
So if you're making lower tier PTEP distributions, you could actually end up with a taxable distribution on a distribution of PTEP from CFC to CFC, which just does not seem right to me from a policy perspective.
And that was just a question that I feel like it came up a lot for taxpayers post TCJA. So yeah, very interesting to see that clarified.
A couple that I had on my list were now applying 267 to 331 transactions. So I cheated on you here a little bit with stepping outside the international provisions, but certainly something that we see a lot in the international cross-border space. A couple others is the 245 Cap A DRD limited to distributions from CFCs.
Right.
So for those taxpayers that have a big 1050 investment, I've used 1050 investment now multiple times here. So for those that have an investment in a CFC that they own between 10 and 50%, those would not qualify for the 245 Cap A distribution, which was a little surprising to me. And then there were a couple of additional retroactive provisions. You had mentioned the potential change to foreign derived intangible income for foreign personal holding company for that doesn't qualify as foreign personal holding company income. There was, and this was, that we could dedicate an entire podcast to this, so I'm intentionally bringing this at the end, is the technical correction restoring 958B4 back to the TCJA when it was repealed. And so, again, I'm not a policy or legislative person. That seems an interesting approach to be able to do a technical correction to restore the 958B4, and there were a number of other provisions kind of related to that. And then the other retroactive one was the 951 A2B changes. That provision was not updated during the TCJA when we introduced 245 Cap A. So it looked like they tried to clean up some of that architecture to make that consistent from a policy perspective with 245 Cap A, although that is a convoluted section. Frankly, it was a convoluted section when it was drafted in 1962. I wrote an article about it, and they've made it just as convoluted to try to get it to square up with 245 Cap A. So maybe here in closing, Sherry, what advice do you have for taxpayers and advisors with respect to all these changes? And again, more thinking about what it could mean to their businesses, and we'll get more of the policy folks here in the near future.
Well, unfortunately for taxpayers, as we've mentioned throughout here, there's just a lot of complexity, additional complexity on top of what they were already dealing with TCJA changes. And so I think the first thing to do is, think about the modeling and looking at, how this would impact you in terms of trying to quantify that. And really get a hold of how these provisions could come into play. And, just even looking, if you think even just about like the FDII changes, I know a lot of companies are going to be thinking about just how does that impact, their planning, things that they were doing. Well, and certainly if it's retroactive, there's more to think about than even just, what you do, prospectively. So I think the modeling part of it, is key as it has been the last few years. And then I think just watching closely, because as we noted throughout, our conversation here, there are some things that maybe don't make sense, like that FDII carve out to DEI that, hopefully we see some changes to those types of provisions going forward.
Yeah, and we're recording this in the middle of September, so it's still early times. In fact, this is going to be one of our fastest turnarounds for a podcast that we've done to get this out to folks. But I would also encourage people to engage with policymakers, right? Things have not solidified. There are a whole number of different constituencies and that we've heard that have expressed concern with this, and in certain industries and certain taxpayers. So I would certainly encourage, it's going to be a fast and furious next couple weeks and few months, it looks like, but would certainly encourage taxpayers to engage with the policymakers to make sure that people understand what some of the consequences of these provisions are, which we attempted to do today.
Yes.
So Sherry, fantastic discussion. Time flies. We covered a whole lot, and I will caveat there's a whole lot we didn't cover and even on my list that we didn't get to. But, as these provisions, if they do get enacted, we'll certainly be talking more about it on the Cross-Border Tax Talks podcast, and I look forward to having you back to talk more about it.
Great. Thanks for having me.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Sherry Grabow, my fellow International Tax Services Leader at PwC. I'm Doug McHoney, PwC's International Tax Services Leader. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.